Good day, fellow investors. Eurofins Scientific is a great business, and now that the pandemic craze exuberance has passed, it's also a business that is fairly priced. So in this video we'll discuss the business analysis, the likely investing outlook, but before, I just released a video discussing what I have on my research platform, and also this Eurofins analysis is now a covered stock on my research platform, so I'm taking the opportunity to also show you how what I do works. You can see here all the covered stocks on my research platform, and now I'm adding Eurofins, and then later in the analysis you will see when this will be a strong buy for me or just an okay good buy like it is now. So if you go to my research platform, here is now Eurofins, just finished the analysis thanks to a suggestion of a few members, and I will cover it, look at the earnings, analyze it, follow over time, and then wait for the lowest risk, highest reward possible opportunistic time to buy. So check my research platform, there are now 4 good opportunistic buys there, and let's start with Eurofins. We'll go through the business, the investing there, and then you'll get a good picture on what this is. So it's a French group headquartered in Luxembourg, better taxes, and what they're doing is testing and support services to the pharmaceutical, food, environmental, agri, commodities, etc. industries out there. So a lot of testing, a lot of laboratories, checking things, and if I look at things and how the world is evolving, it is a positive structural trend there, likely to grow faster than GDP, and Eurofins is a world leader in some parts of the testing environment, which is always good. But also I looked at some competitors, and compared to competitors, Eurofins is more of a one-stop holistic approach that allows it to scale and grow, and therefore I said it is, and it looks like a great business. They want to consolidate and really allowing for scale by creating one-stop shops. So whenever you see a business that has grown fast in the past and is still growing at the market cap of just 10 billion euros, there is a big chance that it might continue to grow forward. And if a business continues to grow profitably, so does your investment. Here are the key investing factors: positive secular trend. As the world grows, they should be able to expand globally. They are investing in organic growth, reaching high single digits there. They have a very strong M&A activity, and given the crash in such businesses, especially genomics, biotech, and something like that, there might be really good opportunities for them as they have an M&A activity strategy that will benefit from lower prices. There is the scalability opportunity from the one-stop shop offering, global growth opportunity, of course. It is small still, it is lean, and they are also focusing on real estate ownership, to own those labs, to get a 10-11% yield on those labs, which is investor mindset and therefore very interesting to watch as an investor. Leading technology, one-stop shop. The key when it comes to investing is to have a moat, and it's definitely high barriers to entry, as it's not that attractive to the great players, but it is important, it is significant. You need to know whether your bananas are poisoned or not, and of course scale matters, and they are growing, acquiring these small laboratories across the United States, across Europe, and you can see here there is plenty of room to grow further. And what they have done in the past, they grew the number of laboratories from 170 to more than 730, and of course revenues grew at 20% per year. This was a bad period for anything related to testing, healthcare, and they made the most acquisitions there in the bad period. Now it's again a bad period, as we have seen from the stock price, and then they might do more acquisition, which is very value investing oriented, buying more when it's cheap and not just chasing acquisitions like Wall Street likes to do. Now let's check the current situation, and of course pandemic testing and reagents are down, but still the core business that's not related has been growing. And if you look at a helicopter view at the numbers, you see, okay, this company is not growing, but it is growing with their standard business, which is always good. Margins have exploded, of course, pandemic testing, but margins are now getting closer to what was the situation before. So we can take approximately the current cash flows as an indicator of future cash flows. This was, okay, exceptional times. And if we look at the current cash flows, they have their own objectives there. So free cash flows to firm around 700 million, and they want to double that in 4 years. If they double that in 4 years and the market is a little bit exuberant, this stock is a free X. I've looked at the conference call, and this is practically a summary of what the CEO says. Opportunities over the next 3 to 5 years on the organic side, also grow, focus, take advantage of M&A, and really create value, continue to create value and scale that business. And when you see those promises, I went and checked what were the promises in 2017, and they reached those promises by 2019. So that is also positive, that when the management says something, they actually do it. You check the past. Also, I went to check what happened here, because the stock was down 40%. There was a Morgan Stanley analyst that didn't like the acquisitions, that said there was absolutely no organic growth, attacking them. They made a lot of acquisition. The market was negative. All healthcare stocks related were going down because of US government. I don't know who it was, Clinton or something like that, yelling that they will cut everything and spending. But that is now behind us. But the stock price, it is not at these levels. But let's say if we take the growth, then it's still below. Now let me give you a few scenarios when it comes to the investing conclusion. The P ratio is 20, growth at 10%, over a few 5 years. If they keep growing, you'll get a good return, around 10%. It could be more. If they hit the 1.5 billion targeted cash flows, a P ratio of 20 on that, that's a 30 billion market cap. That's a free X. And that could happen in 4 years, maybe 5, maybe 6, but if it happens and the market is still excited there, that's a free X. If they don't hit 1.5 billion, they hit 1 billion, P ratio of 15, that's still 15 billion, that's 50%. It's okay, but not stellar. So I think that we are somewhere here for a likely 2x as the average outcome when it comes to investing. If that is in 7 years, that is 10% per year, which is not bad at all. Of course, if it happens in 4 years, 3.6 years, that's 20%, and that's a great investment. But what's my strategy here? I just started coverage on it because of the quality business. I've listened to the conference calls, looked at the competitors, and you can read more on my research platform if you wish, but I don't want to clutter the video here. If there is weakness in Europe, weakness in the US, they spend a lot of M&A, which Wall Street doesn't like when M&A is cheap. When M&A is expensive, Wall Street will get you all the crazy ideas to make acquisitions, but when it's cheap, they tell you don't do it, don't take that. And if we see some further weakness in the European stock market, maybe we can be another 30% down from here for a 7 billion market cap, which would then 7 billion more likely to hit 15 billion in 3 to 4, 5 years. And that's a low risk, 100% return. And therefore, I have put it on my covered stocks lists, and then I always compare it to the other 20s. That's what I do. You can check my research platform if you wish to know more and save time on this coverage, analysts, and everything. I just send you an update, or you can enjoy the video. I hope I've given you value. It's a great business, so you can just put it in your own covered stock list. Thanks for watching. I'll see you in the next video.